All right, guys, let's dive right into it. So, as you can see for the day, we started off a really nice green trend, but we got this major sell-off around 1:30 p.m. Eastern. This ended up making the market go really low and almost similar to what we had a couple of days ago. And volatility was also really high up with a lot of sellers coming into the market. There was a reason for this. We'll go ahead and discuss that in this video. So let's go ahead and dive right into it. So a lot of the stocks were red today. You can see this with the heat map. Almost only certain sectors in healthcare being green, and a few others in the IT sector, but mostly the big names and everybody in semiconductors was all green, with Amazon, Tesla also being green in the day. There was a particular reason for this. Most of these stocks were up on the day and then got a downward trend. We'll go ahead and look at that. During 12:30 to 1 o'clock, Bloomberg reported that Biden was going to be increasing capital gains rate to as much as 43.4%, sounding alarm for investors, as well as it took a major toll on trading profits because people were feeling the need to sell off. So this was basically reported around that 1:30 time, and then after 2:10, the Dow Jones as well as S&P and then the Nasdaq. And most of the gains that we saw during the today in the early market were all down, as well as previous day gains. So what happened? Why is this concerning, as well as why did the market sell off? Basically, he's proposing a tax of 43.4%. That would be a major increase in the capital gains, with the sale of investment from 20% that was previously. So individuals who make more than 1 million annually would be paying a lot more in capital taxes, making it around 40%. And this is also concerning for states and that for individuals that are also paying a state tax. So for example, in California, that would mean a 56.7% as well as 56.2% capital tax that you would be paying in California as well as New York, respectively. So this is concerning for the market because individuals are just going to say that why should I be in the stock market? Why should I put my money, my assets into the stock market? Most of the money that I'm going to gain is going towards capital gains. If I do a really big YOLO on a play that I know is going to do extremely well, and I end up paying most of the money I earn to taxes back, so what's the point? So this made a lot of sell-off individuals starting to sell off their assets, and this is the sell-off that we saw during that time period, and this is why the market crashed today. So going into this, I think this is a bit of an overreaction by the market because this still has to go through. This is a proposed plan. Senate still has to approve this, and there's a lot more procedures, and this could change. The numbers could change. So the market reaction, it does seem to be an overreaction, but overall the tax rate for individuals are probably going to be increasing this year from Republican to Democratic respectively. So this is still a concern for individuals that are making more than 1 million. And this also goes ahead and dive into deleveraging phase, and is a concern and an indicator for a deleveraging phase as well. So I'll go ahead and just show you guys a clip of Ray Dalio talking a bit about deleveraging, and you can see that the four indicators for deleveraging, as well as to showcase how we are in that deleveraging phase, as well as our bubble could pop during 2021, 2022. So just to give you guys a heads up and be informed, not to make you panic sell or anything like that. You should always be informed, seeing what's happening in the market, so you can go ahead and sidestep some of the crashes.
There are four ways this can happen. 1. People, businesses, and governments cut their spending. 2. Debts are reduced through defaults and restructurings. 3. Wealth is redistributed from the haves to the have-nots. And finally, 4. The central bank prints new money. These four ways have happened in every deleveraging in modern history. Usually, spending is cut first. As we just saw, people, businesses, and even governments tighten their belts and cut their spending so that they can pay down their debt. This is often referred to as austerity. When borrowers stop taking on new debts and start paying down old debts, you might expect the debt burden to decrease. But the opposite happens. Because spending is cut, and one man's spending is another man's income, it causes incomes to fall. They fall faster than debts are repaid, and the debt burden actually gets worse. As we've seen, this cut in spending is deflationary and painful. Businesses are forced to cut costs, which means less jobs and higher unemployment. This leads to the next step. Debts must be reduced. Many borrowers find themselves unable to repay their loans, and a borrower's debts are a lender's assets. When a borrower doesn't repay the bank, people get nervous that the bank won't be able to repay them, so they rush to withdraw their money from the bank. Banks get squeezed, and people, businesses, and banks default on their debts. This severe economic contraction is a depression. A big part of a depression is people discovering much of what they thought was their wealth isn't really there.
So Ray Dalio talks about the four things that always happen during a deleveraging. So deleveraging is a little bit different from a depression. During depression, you can lower your interest rates in order to increase spending as well as lower the economic impact of the depression. However, in deleveraging, you can't do that because interest rates are already low. We can see this in our current economy as well because interest rates are at historic low levels. So we already see one of the things that Ray Dalio mentions: the Fed is printing a lot of the money. The US has printed over 20% of their money during the pandemic, as well as we've seen multiple stimulus checks being given out. Now this is resulting in a huge supply of money as well as inflation concerns during the market. Also, we can see that there are attempts to redistribute wealth from the wealthy. So this proposal, which targets the wealthy who are earning more than 1 million, the top 1%. This also leads to individuals cutting spending in order to pay off their debt as well as to lower down the leverage, resulting in selling of their assets, and further negatively impact stocks as then the economy going in a further downward trajectory. So this new plan by Biden means that the federal taxes for the wealthy investor could be as high as 43.4%, including the 3% Obamacare, making returns on financial assets and the tax rate on financial assets to be higher than wages and some salary incomes. So the stocks did slid the most in more than a month on the news, with the S&P 500 index down 0.9% at the close today. Biden is expected to release a proposal next week as part of the tax increases to fund social spending under the forthcoming American Families Plan. Biden has also warned that those earning over 400% could expect to see more in their taxes as well. And this is also being done by the White House to fund out their $2.25 trillion infrastructure plan, focusing on American jobs. So this plan would effectively and carried interest benefits for fund managers as well as investment advisors, family funds, big firms who are really heavily invested within the stock market and have a lot of their money in stocks. This would also negatively affect individuals, even if they don't have to pay this tax, as they don't have over 1 million, because as stock prices goes down, their returns also go down. And this could lead to a panic from individuals, big money, as well as algorithms who are looking to sell the news. Overall, we have to wait as Biden will detail the American Family Plan in joint address on Congress on April 28th, so we will be on the lookout for that. So the overall purpose of these videos is to inform you about what's happening in the market so you can make informed decisions as well as what investments you're looking to make. It is not to panic sell. You should be looking to long-term hold anyways. That's what we do on this channel as well. So we have huge conviction on our long-term plays and we plan on holding them for at least 5 to 10 years. So in the long term of the scheme of things, this really does not matter, but this is something you should be concerned about as well for the short term when you are looking to buy your stocks. So if you did learn something new and did enjoy the video, like and subscribe is much appreciated, and I'll see you guys in the next one.